I think that makes sense. I mean, first of all, investors are just suffering from incredible tariff whiplash. I mean, it's we have somebody on my team whose job it is every day to try and figure out the effective average tariff rate that the United States is deploying on or imposing on everybody else. And Mary Park does a good job, but she's the hardest working person on my team, and just trying to keep up with
So
that.
what do you guys see? Because our Bloomberg economics team is basically roughly 13-ish percent is what they're saying.
That's where we're ending up too. And of course, that assumes the same. You don't allow for a change in the volumes of trade. And we know the volume of trade will be impacted by this. But it is, and I think that's the important point. Because, you know, where were we at the start of the year? We were about 2.5%, and now we're 13%.
Yeah.
And so, yes, the market didn't bounce off of the idea that maybe this all gets blocked. But even if it did get blocked, I mean, why should we be up year to date? I mean, if you think about the economy we came into this year with, we had a good economy,
right?
But we also had a lot of optimism after the election. And since then, we've had sort of the Doge cuts. We've had all this controversy around immigration. We've had budgets, a budget proposal, which looks like it's going to expand the deficit in 2026, 2027. And most of all, we've got all these tariffs, which are throwing sand in the gears of global trade, and all the uncertainty that's coming from all of this. And all of that is still weighing on the market. So the market should not be higher than it was at the start of the year. And I think maybe if we don't bounce off every little piece of relief, it's because, this picture overall is still pretty uncertain.
Right. Uncertainty still rules. You know what I think about? And David, you got a PhD and an MA in economics from Michigan State University, a BA in economics from University College Dublin in the Republic of Ireland. I studied economics. I keep thinking about the cross-section of economics and markets. And I'm wondering if the global economy is still as intertwined as it was, or are we kind of opening up a new chapter on that?
I think I think other countries are more dependent upon global trade than we are. The United States only imports about 15% of its GDP. It exports about 11%. If you go to places like the Eurozone or the UK or Japan, those numbers are much, much higher. So what happens in the United States is actually mostly about the United States. But still, these tariffs do push up prices, and they do slow our exports, and they do add uncertainty, particularly for global U.S. companies. Because even though the U.S. economy is pretty domestic, all of these companies are not that domestic, and it's difficult for all of them.
A couple of truths about our economy. One is it's powered by consumers,
yes,
and it's powered by services. Given that the average tariff rate is really 5x since the beginning of the year, what does that do to consumers?
It punches them, but it doesn't fell them. I mean, it's definitely a negative, but we have the most resilient consumers in the world. I mean, unless you melt the plastic, they will keep on spending. And I think we've seen that. I mean, even in the first quarter, with all this going on, consumer spending was rising. I think it's going to rise again in the second quarter. Not that fast, but consumers try to put on the headphones and ignore it, and so we're still seeing that. So I think that's one of the big advantages of the U.S. And of course, we have had huge gains in wealth in the last few years. People can spend some of that. I think people try to just drown out the noise coming out of Washington as much as possible.
But help me out, because often when we see debt levels, consumer debt levels go up, and then we're looking at whether the ability of consumers to actually pay it. I mean, we get concerned, we get worried, because there is a point where, right, your debt becomes potentially for a household problematic, or that debt is so much and mortgage rates are still higher than they were, that like people don't do these kinds of things.
It's a drag on the economy, but it's not fatal. The thing about debt, of course, is the rate at which you finance it.
Correct.
And 2/3 of U.S. household debt is mortgages, and those mortgages got locked in at 3-point-something% a few years ago. Now, that is a huge problem for people trying to buy a house right now, because that mortgage is not available and it's not going to be available.
Right.
But it also means that the actual debt service ratio, the percentage of disposable income that people are using to service their debt, is way down from where it was before the great financial crisis, and it's still not that high. So, people talk about credit card debt, but credit card debt is actually a pretty small part of overall consumer debt. So overall, we're seeing, yes, there is some strain from increased credit card debt, slow increase in delinquencies, but it's nothing like before the great financial crisis.